Hey everybody, my name is Brandon, also known as FNP Trades. Today I have a video for you guys about the stock market 101. Pretty much the basics. This isn't an in-depth how-to with the stock market, but it is pretty much a combination of all the things that I have learned over the time that I've been spending in the stock market. And a lot of people have been coming to me asking me like, what do I do? How do I do this? And XYZ. And so I decided to make a basic like entry-level course about the stock market and the things that I look at and why I do it and etc. So I would like to thank you guys for tuning into the video, and we will get started in a second. First and foremost, I just want to thank you guys for even like tuning into this video. So hopefully you guys find some information from this that is helpful, and hopefully it helps you guys on your trading journey and help you guys to understand the reason why I am so passionate about this and the reason why I want to do what I do. So without further ado, let's get started. Stock market 101, the basics. All right, so first and foremost, this is not financial advice. Nothing in this video is considered investment advice, and it's strictly for educational and entertainment purposes only. I am not a professional trader. I am not a financial advisor, CPA, or anything like that. This is just solely on the courses and everything that I've taken and that I've learned from, and I am presenting them to you guys as educational information only. So I would not be liable for any investments that you guys make or win on or lose on. It is just my duty, or I am just coming to you guys to show you guys what I do and how I make profit from what I do. So a lot of you guys don't know what the stock market is. The stock market is essentially an exchange. It provides access to companies that are public. So pretty much the stock market, it gives you the ability to purchase a stake in a company that you believe in. Purchasing a stock allows companies to use that capital to make enhancements or upgrades to hopefully increase their revenue long term, which in return would increase the stock price and will also increase the profit that you make on it. When you buy a stock, you become a partial owner of the company. Purchasing a stake in the company, even if it's one share, makes you a owner of that company. So when you buy a stock, you're buying a company. Example, let's say you go to McDonald's all the time. You love McDonald's, you love their chicken nuggets, whatever. You say, hey, even during the pandemic, McDonald's never suffered. They were open the entire pandemic. You felt like this would be a great company to invest in. You see that they're pretty much recession, pandemic proof. You buy a share in McDonald's at whatever price McDonald's costs. You essentially become a owner of McDonald's in general, whether it's in America, overseas, whatever. You are a owner of McDonald's. And the thing about a company like McDonald's is it's so big. They have billions of shares out there. So if you own one share, you're like 1 billionth of an owner, but you are an owner of that company nevertheless. So when you go to order your McFlurry or whatever, you say like, hey, I own McDonald's. You're paying those people. So yeah, I think that's kind of cool. But essentially, that's what the stock market is. You're buying a stake in a company that you believe in and a company that you think is going to continue to grow over your lifespan. So how do you buy stocks? You buy them on exchanges. I know a lot of people have heard of the New York Stock Exchange. That is like the big main one. That's the one that's in New York, obviously by the name. And then you have these other exchanges as well that trade, that allow you to trade stocks on. The Chicago Board of Exchanges, another one. There are a ton of exchanges, but New York Stock Exchange is the biggest one. In order to buy stocks, though, you need a broker to buy them. So you have to have a middleman to allow you to trade on the New York Stock Exchange, to trade on the Chicago Board of Exchange, and et cetera. So that's where apps like, or brokers specifically, like Robinhood, TD Ameritrade, E-Trade, Webull, Fidelity, Charles Schwab used to be one, but I believe they got bought out by TD Ameritrade. So you need a broker. I would avoid apps like Acorns and Cash App to buy stocks on because they aren't really brokers. They're like middlemen essentially. So they use a broker like Robinhood, TD Ameritrade, E-Trade, or whatever to buy from, and then you buy it from them. So it's changing hands too many times. So I would just stick to like the main brokers, which is Robinhood, TD, Webull, Fidelity. Me personally, I love TD Ameritrade. Robinhood is great for beginners, but once you realize, once you start to make more money and you realize more strategies and everything like that, I think a broker like TD Ameritrade will take you a little bit further. Each of these brokers have pros and cons. Robinhood is pretty much essentially free for their commission free for the entire thing. For their entire platform. TD Ameritrade is also commission free as well, but for the trading that I do pay a commission for options trading, and then a company like Webull is like the best of both worlds for Robinhood and TD Ameritrade, but it has its limitations as well. And I won't go into all of the limitations at this moment, but as we continue to grow this channel and as we continue to grow with the educational sector of what I do with stocks, then we will come out with more videos going forward with that. But essentially, you need a broker to buy stocks. Download any of these apps and you will be able to access the stock market. So what makes a stock move? Essentially, the stock market is a big auction. Think of it like eBay or StockX. If there are more buyers than sellers for a particular item, the price increases. If there are more sellers than buyers, then the price decreases. So think of it like the housing market right now. There are not a lot of houses out there. So because there aren't a lot of houses, but there are more buyers, people who are in real estate are making a killing because they can increase the amount that a house is worth because they know that it's a hot commodity. Everybody wants this house. So because they know that everyone is struggling to buy property and everybody wants to buy property at the same time, they can increase it to the highest bidder. The same thing happens with the stock market. Let's say there's a pair of Jordans that come out over the weekend, and everyone wants to get these brand new Jordans. There are more people who want to buy the Jordans than sell the Jordans. So you can buy them at retail if you get lucky, but then once people buy them, you see them on eBay or StockX, and because everybody wants those shoes, you see the price of those shoes increase way more than what you would have paid for retail. So you're paying resale costs for something that you could have got at price if there wasn't such a high demand for it. So essentially, that is like the biggest thing about what makes a stock price move up or down. And then another thing that affects it is like bad news, bad earnings, sales. An example of this would be Peloton had a recall on their treadmills. So apparently the treadmills had caused one treadmill had caused the death, and then multiple other ones had faulty something, and it caused a bunch of injuries. So they were facing scrutiny and backlash for that. So that caused the price of Peloton stock to drop significantly in one day. And then it slowly rose back up, but it's just one of those things where it's like you get bad publicity, the stock will drop really fast, and then over time people will be like, well, once more news comes out about it, then it makes it goes up. It makes it go up. Another thing would be fear and excitement. People may be scared that something is going to come, i.e. the pandemic. The pandemic is caused a lot of people to sell out of their stakes in different stocks that they had because they were uncertain about where the market was going to go. So that caused a market crash essentially. And then people get excited once they found out that the presidents were going to be releasing stimulus packages. People were like, all right, well, now we're heading in the right direction. So that excitement allowed people to buy back into the market and to increase the stock prices for different ETFs and different companies and XYZ. So that's another thing that moves it. And then you have Warren Buffett, Kathy Wood, Elon Musk. Those are like three of the biggest like stock celebrities there are essentially in the world. Warren Buffett is probably regarded as the smartest man when it comes to investments because he's usually never wrong. So people, his company, Sachs, what is it? I'll edit that out. But his company, Goldman Sachs, like that broker, that hedge fund, they have had consistent growth throughout his lifetime because of the moves that he made. Kathy Wood is another one. She has her own. She's the female Warren Buffett, essentially. She has the ARK funds, her investment company, her investment portfolios, her hedge fund, her company. They're on par with Warren Buffett. If she thinks that she sees something good for the long term, she adds it to her portfolio so that her funds can perform at the maximum level. I think one of her ARK fund, her ARKK fund, has had like 15% return on investment every year since its inception. So that, I mean, you got people who are like doing really, really well, who just invest in her fund. So, she's pretty good at what she does. And then you also have Elon Musk, who is regarded as, the Doge fodder, but he's pretty smart as well. He owns Tesla, SpaceX, and a bunch of other brainchilds of his. But he's highly regarded in what he says as well because they think he's the future. But overall, the market is fueled by fear and greed. So essentially, those two things are what makes a stock move. So you got the people who are rich; they want to get richer. You got the people who are rich who get scared, and then it makes the market move. So with a stock, it can only go three ways. It can go up, which is bullish, down, which is bearish, and then sideways, which means it's ranging or consolidating to make a move either up or down. Essentially, that is it. A stock cannot do anything other than that. And then for a chart breakdown, what I use is candlesticks, this is typically regarded as the main way that people interpret charts. They look at candlesticks. So if you look here on the picture here, you have a high, you have a low, and then on the green candle, you have an open and a close. If something is going up, the open is at the bottom, and then as it goes up and it closes at the top. And then for something that is bearish or going down, you have the open at the top and the close at the bottom. And then what you have here is a wick at the bottom, and then you have a wick at the top. All candles do not look the same. All candles have different patterns. That is for another video. But I just want you guys to know that there are some patterns that indicate a move to either the upside or downside or a range. So you can look at candlesticks and determine what a stock is going to do just by looking at what these candles look like. So the reason why you have a wick right here at the bottom is because price went down and touched as far as the stick was, and then it went back up. And then you have the price went as high as this wick and then went down and closed here. And then same for this candle here, price went as high as up here and came down, and then price went as low as here and went up and closed here. So those are things that you can look at when you look at a candlestick, and this is the body. So this is the range of the candlestick. Essentially, both of these are equivocally the same. So you look at the range and you see that's where a stock traded at. If this is like a daily candle, so the price for the entire day's movement would be within this body. And vice versa for whatever time period you look at it. And then there are some indicators that I use. I use for EMAs, I use volume, the RSI, and the MACD. They all have different things, but we will talk about that in the next slide. So the MACD, essentially the MACD is the moving average convergence divergence. So to make a long story short, pretty much what you do is this is the zero line right here. And as the stock trades under that zero line, it is bearish. And then you want to look for a cross like right here, which could signify that a move to the upside is beginning to happen. So if you look here at the cross right here, you can see that it looks like it wants to start to do a reversal pattern. So when you get this, it looks like that, but this is an early signal. You still don't want to get into a trade to the long side until it crosses over the zero line. Once it crosses over the zero line, you see that the stock goes up, and then it goes for a run. So it's over the zero line. You got the positive cross and it's going up. The stock begins to go up. And then for moving averages, these are just simple moving averages, but they move the exact same way. Not simple moving average, but basic moving averages. They're EMAs, which is what I exponential moving averages. But these aren't the ones that I use. But I felt like in the video, I felt like this picture had good EMAs on it, so I just used it because I like the way that it looked. So this is a 12-day EMA, and then the 26-day. The 12-day is faster than the 26 because it only looks back 12 days, and the 26 moving average looks back 26 days. So this is the slower one. So essentially how I utilize EMAs is when the fast EMA crosses over the slower EMA, that means that it's bullish. And essentially you see the same thing down here. The signal lines crossed, the blue signal line crossed the purple one, which means it's bullish, and they pretty much do the same thing. You'll just see that it crossed a little bit faster on the MACD because the MACD is a leading indicator and the EMAs are a lagging indicator, which means the MACD is going to be a little bit faster to tell you about what is happening versus the EMA because they got to use the close of a candle. Of previous candles. But essentially what you see here is across to the bull side and a stock moving up and continuing to move up. And then over here you got the opposite. You have the slower day moving average over the faster day moving average, with signals that it's a bearish trend. And as long as the red is above the green, that means short, 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 short. And then you see that they begin to converge, which is essentially what the MACD signifies. Once you see that they begin to cross, then that is a positive thing, because as you can see, when it crosses, the stock goes up, comes down, touches, and then what you would like to see here is they'll touch and then a bounce to the upside. So that's how the MACD and the RSI look, the MACD and the EMAs look. And then here we have the RSI. This is also another leading indicator, but essentially you use it for two things. It lets you know whether or not a stock is oversold or overbought. Overbought would mean that a stock went on a run to the upside, and then it is signaling hot. If it gets hot, it means get out. So as you can see, when it hit the overbought territory, it was up here at a peak. And then what did it do? It began to sell off. It sold off, it sold off, it sold off until it got to the oversold territory. Once it got to the oversold territory, which is right here, you'll see that it's all the way at the bottom. It started to go back up. It trended up, and you can see it on the RSI that it is trending up. It got back to the hot territory, dipped down below it a little bit, went back up, went back up, went back up, and then dipped. And then as you can see, it's like consolidating now. It's still in the hot, but if I had to make a bet that it was going to go down some more, it probably did go down a little bit more before it started to reclaim up. If I had to guess, I would say that it probably went down to about here, because that looks like another level of support. But you can see that back here as well, where it hit overbought and then it started to slowly go down, and then it hit oversold, went back up, overbought, went back down. Essentially, the RSI is just another tool that you can use. And then you have two ranges. A lot of people like to keep it at the default range, the 30 and 70. And as long as it's trading in between these two, that's where you know whether or not you can take a signal or not. When it gets to 50 is typically the mid range between the two. So usually once you get to 50, depending on which direction you're going, that lets you know that's typically a buy signal. But I like to use the oversold territory as the buy signal instead of the 50. The 50 is my confirmation that I could possibly add on to a position and ride it up until it gets to about 70, 80. and this right here looks like about 80, and it got really hot. So, RSI is another tool that you can use, but now I typically use just the EMAs, the MACD, and the RSI, and that's pretty much it. So I do have a chart example of all of this stuff. What I like to use is TradingView. If you don't have a platform like Thinkorswim, I think Thinkorswim, which is TD Ameritrade, is a better platform, but TradingView is also really great. A lot of professionals use TradingView for charting. Webull also has a good charting platform, and then stock charts as well. So what we're going to do is we're going to head over to TradingView and look at the Tesla chart. So I already showed you guys pretty much like what I look at. Again, we have the chart, the EMAs, we have the MACD, and then we have the RSI. So essentially what I look for on a chart, which I'm not going to go into full depth, but as you can see, I have 4 different indicators on here. I have the 8 EMA, the 21 EMA, which is blue, the 50, which is gold, and then I have the 200, which is white. Essentially, whenever a stock is trading above the 200 EMA, I'm bullish on it, and whenever it is below the 200 EMA, then I'm bearish on it. So let's see, let's find. So as you can see, because the stock is under the 200, is down, and it wants to get back to that. So that's how I look at it. So this right here, this would be what we call a death cross, because it's trading above the 200, and then all of a sudden all the EMAs go below the 200. So you would not want to get into a call or a long position after we see this cross, because it signifies that there's going to be some downside. And as you can see, we get a sell-off going down, and then as the candles start to consolidate, you see that it tries to get back above it. It doesn't quite do it. It moves sideways, and then eventually it gets above it, and then it runs. But as you can see with those crosses, you also get those on the MACD. You get that on the MACD as well when it's going up. So down below, we have it here. You would have been able to see that this move was going to happen pretty shortly, because we have the blue line cross over the red line, which means that it's a signal for a possible reversal of the trend. You can see it happened here before it happened over here. So you could have entered right here, and then you look at the RSI on the MACD is getting closer to that 50, which would have told you, all right, something's cooking, because it's already leaving the oversold. And then now all your EMAs begin to cross over. The MACD is beginning to cross over, and then the RSI is starting to get up to hot territory, starting to move upwards to the 70 line, which is past the 50, but you know that it is good. And then you start to move up, and you move up, you get to oversold, then it sells off a little bit, and then it hits that 50 line, and then it goes right back up, runs back up. As you can see on the MACD, it's crossing, it's beginning to give you a cross to the downside. It's hot on the RSI. What the stock does after that, it goes down. As you can see, it goes down below that 50 on the RSI. It goes back down and touches the 50 on here. It starts to move back up, sideways, and then it gets to the 0 line, and then it makes a rapid turn, and then it runs back up, gets up here. You get that cross again on the 8 EMA and the 21 EMA. The 50 EMA is going to be a little bit slower, but you get that cross. You get the cross right here on the MACD. You get the hot on the RSI, and then the stock sells off. You get a cross. It goes to the upside temporarily, goes back down. Now you got another cross to the upside, then down. And as you see, it pretty much follows the pattern. So that's why I like to use these EMAs. and then the MACD and the RSI, because they can let you know, or they're just another tool to help you confirm what you already know when you do your technical analysis on a chart. So sorry if I'm a little long-winded. I like to explain stuff in depth, so I apologize for that. But let's get back to the presentation. All right, so that was the Tesla chart example. All right, so essentially, before you get into the market, you want to make a plan. You want to know what you're going to do before you do it, and you want to make sure that you execute it the way that you plan it out. Consistency is the key. So regardless of what kind of account size you have, you always want to try to aim for about the same amount for each trade. So when you open a trade, you should only use a percentage of your account. So for example, let's say you have $1,000 account. For each trade that you take, I would recommend using only 100 to 200 per trade, which means that you have the same amount per trade. And then when you do that, it helps you limit your risk and exposure. So let's say you have a trade planned out, you think it's going to work in your favor, and then all of a sudden it doesn't. The maximum risk that you can make if you don't set a stop loss would be whatever you used per trade. So if you put up $100 as collateral for your trade to make some money, you can only lose 100, and you don't want to YOLO your whole account because your max loss is only what you put in. So if you have $1,000 account, don't put 500 in there, because you could lose that 500 if that trade goes sideways, and vice versa. And the smaller your account is, the more risk management comes into play. Like you would, like, on a trade that's $100, you would probably only want to lose $20 on that trade, but the maximum profit should be 2-to-1. So you would probably want to lose 20 if you can make 40. And proper risk management is the key to that. The whole goal of playing in the stock market and learning how to trade in the stock market is to live to fight another day. Cut your losses early, and take your profit. That's it. Don't hold on. Take your profit. Typically, I like to take profit at 20-30%. And then anything more than that, that's a plus for me. And that's for day trades. For swing trades, I like to aim for a little bit more, but at the same time, you can't get greedy in the market. Greed will get you burnt. A lesson that I've learned a lot of times. There have been numerous times, even this past Friday, when I've been up 80%, 90% on the trade, and I held it too long and didn't get out of the trade, and I ended up going negative on the play. So it's things like that. So you want to live to fight another day. You want to limit your exposure. You want to make sure that you have proper risk management, and that discipline. Having that discipline will help you help your account grow. So investing versus trading. So investing is pretty much what your 401k, if you have an IRA, all of that stuff, that's what that is essentially. The long-term holds. They're money that you're putting into a fund, and you're letting the hedge fund or whoever your company's 401k or 403b provider, you're letting them run that account for you. You're giving them money. They're putting the money into the market for long-term holds for you, so that you can get a retirement. Companies that they believe in, like a lot of these companies, essentially all they do is put your money in the S&P 500 or an account that is similar, or ETF that is similar to the S&P 500, so that you can get like an 8% return on investment every year. And essentially that's it. You set it and forget it. It's money that comes out of your paycheck that you're paying someone else to put money into a fund that you can do yourself. It's interesting, but essentially that's what it is. So companies, pretty much for investing, you're just putting money into companies that you believe will continue to grow as you age, i.e. McDonald's. I used the McDonald's example earlier. Home Depot, there are always going to be people willing to do home renovations, trying to improve the way that their house looks and stuff like that. So Home Depot is always going to be something that's going to increase. Maybe you think Tesla is the future. You think electric cars EV vehicles are the way to the future. Tesla is a company that you want to invest in. Coca-Cola has been around forever. It's recession proof. People are always going to want to drink soda, at least until they don't want to anymore. But they have a vast majority of different products, so it doesn't matter. They're always buying companies, vitamin water, smart water. They have so many different branches of their company that's not just soda. They have holistic stuff. So maybe you think Coca-Cola is going to be a great company. Clorox, you saw what happened during the pandemic. Bleach, toilet paper, all of this stuff, it just like flew off the shelves because people took a keen interest in hygiene at this point because of the pandemic. You think that people just went crazy over the pandemic. You got Procter and Gamble; they make supplies for cleaning and all of that stuff as well. So, stuff that's always going to be here, stuff that's going to age as you go. The banks, Chase, J.P. Morgan, Bank of America, banks aren't going anywhere. They have the Fed to back them. So, a lot of smaller banks might get the funk, but bigger banks like Chase and like Bank of America and Wintrust and stuff like that, like those are banks that you want to invest in because they've been around forever. And then if you are doing investing, like you want to look at index funds like the S&P 500, NASDAQ, Dow. The S&P 500 is pretty much the best companies in America. It's the top 500 companies in America essentially. And whatever company that underperforms, they go in, they reevaluate, they drop it and add another one in there. So they always got the top 500 always. And then essentially every bank and hedge fund wants to be like the S&P 500 just because of the way that it's managed. It's always going to be positive over the years. If I pull up a chart for the S&P 500, it goes in one direction. It only goes in one direction, and it goes up every year. So, these people, they want to compete and they want to outperform it. Some do, some don't. But over the lifelong span of the S&P 500, it's always beat out every other hedge fund or investment fund there is. And then, so that's investing. Trading is more of what I do because I want to take my money and continue to increase it as I go on a week-to-week basis. So there are many different ways of trading. You can be a day trader, you can be a swing trader, and swing trading is weekly, monthly, yearly, and then day trades are things that you open the trade and close the trade on the same day. There are limitations when you do that, especially if you have an account with like Robinhood and you don't have over $25,000. You'll get hit with a pattern day trade rule, and we can speak on that more at a later time. But know that a cash account is the best kind of account to have because it's money that you own and money that you have, and you're not borrowing any money to make any trades and stuff like that. So you don't have any leverage. So you can only trade what you have, and that's why I like those kinds of accounts. But trading is more short term with the same premise as investing. You're still going to invest in companies that you believe in, but you want it on a shorter period of time. So a lot of these companies, they move in increments of like $5 to $10. Sometimes like Tesla ran from 620 to almost 700, which is almost unheard of, but it did that in like 3 days. So if you were someone that saw that on the charts and saw like, hey, Tesla's about to make a run, that's one of those things where you could just look at it and you can buy in on Monday and get out of it by Friday. As a swing trade, and you would have made a handsome amount of money. I know me personally, I got in Tesla at for $28. I had 3 contracts for $28. I sold the contracts when they got to $80, but they ran to be worth as much as $900. So, like things like that, like that's why I love doing what I do. So that's trading versus investing. And how do I trade? So I trade options. I trade options contracts. Contracts are the right to buy 100 shares of a stock by a set date. They are a way to get into trading without having a huge amount of money. Like an example, like 1 share of Tesla is right now at the current moment is worth $671.80. 87 cents. I don't know about you, but I don't have $670 some dollars to buy a share in a stock at the moment. So what an options contract allows you to do is to make money on the stock movement without having that kind of money to put up as collateral. Plus, like if you pay $671 for a stock and it goes up to $675, you're only going to make $4 on it. So it's just like one of those things where it's like you got to have more shares of something to even get some type of return on investment. So that's why I like options, because you could buy an option for a set price, and as the stock moves up, you make more money on it. So as the stock goes up, if you buy a call, the price of your contract is gonna go up, and then if it goes down, then the price of your contract goes down. But you can also bet that a stock is gonna go down with a put contract, and you can make money on the stock if it goes either way. You can only do this with options contracts. You can't do this with shares, because the only way that you make money with shares is if a share price goes up. And that's the only way you can make money. But if you buy a contract and you think that a share is going to go down, you'll make money on it that way as well. So that's a benefit of an option contract, because you can make money if it goes up, you can make money if it goes down. And then there are a whole bunch of other different strategies out there that I don't necessarily partake in, but you can make money if a stock trades sideways as well. So, it just depends. It just depends on like what kind of trader you want to be. There are a million different ways to get into the stock market, but this is how I do it. And this is like the basic way. So how do options work? I gave you guys a little bit of an example before, but here we go. You pretty much buy a contract from someone who has the 100 shares of a stock. You make an agreement to buy the contract for a set price, and they will put up their 100 shares as collateral while they collect whatever you pay them. So like, let's say I own 100 shares of Apple, and you think, first of all, I own 100 shares of Apple. Each share of Apple is worth $120, right? So when $120 per 100 shares is $12,000. That's how much money you have to buy 100 shares of Apple if it was trading at 120, right? That's absurd. Like, I don't know about you, but not a lot of people have $12,000 to be able to trade 100 shares of Apple like that. So the way where options comes in is like, let's say you think Apple will get to 140 by the end of the week. You think that they just dropped some news on like a new iPad or a new iPhone or something like that. They have a new product coming out, and you think that that product is going to run the price of Apple from 120 to 140. You can buy a contract from me. I'll put up my 100 shares of Apple for you to pay me $20 for a contract that will expire on Friday, so that you can potentially make money off of my shares, right? So you give me $20 on Monday, we write out a contract. I'm like, hey, you have the right to buy my shares of Apple at 140 if Apple goes up to 140 by Friday, right? So you buy the contract, you wait it out. The closer Apple gets to 140, the more valuable that contract becomes, and vice versa. So as the price goes from 120 to 125 to 130, your $20 starts to turn into $40, $50, $60, $70, $80, $100. You name it. The closer it gets to 140, the more money you make on it. And so what happens is, once that price goes up and you feel like, hey, you know what, I made enough money on it, you sell that contract to someone who is willing to buy those Apple shares, someone who has Apple share money, someone who has, so at this point it'd be what, $14,000, someone who has $14,000 to buy those Apple shares on Friday when they want to have those shares. So, that's pretty much what you do. So you buy a contract and you flip the contract, you make money off of the contract, and you sell the contract to someone for more money who has the money to be able to buy those shares of Apple. And then you get out of it. You get out of the trade. Your max risk, the maximum that you're risking is $20. Your maximum gain is unlimited. Let's say Apple goes way past 140. So now that contract is not Now, it's not worth $20. It's worth probably a couple of $1,000s. Now, let's say it's unheard of that it goes to $200. You're sitting on a pretty nice chunk of change. $20. And most people, for let's say if you stuck to the plan and you bought a contract you spent $100 on contracts, you have 5 contracts at $20. That's 5 contracts, 5 times whatever your profit is. That's how much you gain. And now you're sitting on a chunk of money all for $100. And that's the beauty of options. But again, like I said, with options, there is also a risk, but you're only risking what you put in. So if you put in $20 and you let the price of Apple doesn't go in the direction that you want it to go to, let's say it goes below 120, the closer it gets to 110, the less valuable your contract is going to be as well. So it works the same way. But if you bought a put contract saying that you think the price of Apple is going to go down, then that's how you make money on it as well. So that's like options in a nutshell. But on the next slide, I believe I have an example of like what options spread looks like. Yep, I do. So I actually have Apple up here just for references. I like the price of Apple is currently at $132.95. So this is an example of what I was talking about. So this is for Friday, July 2nd. Let's say you see the price right here is at $132.95. You think by Friday, July 2nd, that the price of Apple is going to go to $135, right? That's kind of reasonable for Apple because it typically moves a couple of dollars in a day, right? So let's say you were to buy this contract on Friday at right before market close, right? You would have paid $56 per contract. So it shows up as like 56 cents, but you multiply that by 100 and then you have $56, right? So you buy this $135 call for $56, and the closer the share price gets up to that, the more valuable this contract becomes. So we can use this for an example. So this is called out of the money because the price hasn't hit these numbers yet. And then this is called in the money, which means the price is already there. It's already 131. It's already at 132.95. So all of these are considered in the money. So you will lose less on these, even if the price goes down. So what you hope is by Friday, this Apple price gets to 135 so that it makes your contract more valuable. So I'm looking at this right here. I'm looking like this contract right here is in the money already, and it already hit 132. So whoever bought this contract, if they had a contract, it was probably worth closer to this $50. And let's say the stock share gets up to 136.95. So then now this contract that's originally worth $56 is probably worth like almost $200 now, and then vice versa. And then this contract will probably be worth closer to $400 or $500. So this is how options contracts work. So the closer the more the price goes up, the more valuable these contracts become, and vice versa. So that's a cool thing about options. So what are the pros and cons? As I said, the pros are you can get higher profit returns quicker than trading a traditional stock. You can start with less money as well because they're more cost efficient. You could literally start with $20 to buy a contract. You don't really need a lot of money to start with options. But for higher profit returns and quicker trading, you can literally make money faster in 15 to 20 minutes than what you could possibly make at your 9-to-5 job. I know there are a lot of people who played Tesla this week specifically and made a couple $1,000s, which is more than what their paycheck is on Friday, and they only played it for one day. You know what I'm saying? So you can make thousands of dollars in trades for just 30 minutes a day. There's a little typo right here. But some people are only in the market for 15 minutes. Some people are only in the market for 30 minutes. But in that little short period of time, people make so much money that they can be done with their day. I know a lot of people, they wake up, They do their day trades. Once they make the amount of money that they want to make, they're done, and then they go about their life. They do whatever they got to do. There are people who do this for their job. This is their job. This is their primary source of income. They're in the market for 10 minutes. They leave the market. Go do whatever they want to do. They have total, complete freedom to do whatever they want to do because they have it locked down. So the cons of options contracts and trading them is that they expire. You don't own the shares. So because you don't own the shares, you don't really have you don't own them. So you don't have any type of relationship with the stock. So if the stock goes down, you're pretty much screwed. But with stocks, if you own the stock can go down. But if you hold it for longer, it's going to go back up. It's going to go back to where you bought it at, and then hopefully it'll continue to go up for you. But options contracts are riskier than buying shares for that reason, because you don't own anything. And once it hits the expiration date, it will expire, and your contract is worth nothing at that point. And then another thing that I didn't really talk about, but like as something gets closer to the expiration date, your option loses value. So it's the same thing as like go to the grocery store and you're trying to buy eggs, and they say that the eggs expire on a Friday. So the closer you get to the expiration date, the cheaper that they're going to make those eggs so that someone could buy them, right? But and that's regardless of where it came from. It could be Dean's Farms. It could be, whatever farm it is. It could be the top tier, the holy mecca of milk. But the closer it gets to the expiration date, the less valuable that contract is going to get, unless there's a volatile swing in that stock price. So just something to think about. That's something for another video we'll talk about that has to do with the Greeks. But for simplicity's sake, we'll stick to what I've said already. So why do I trade? My goal is to be financially free. I don't want to be limited in what I can do. I want to be able to fire my job and live life the way I want to live. I have a great job. I am a nurse. I love my job, but at some point, I feel like I want to have a little bit more flexibility. Working nights is cool. I'm just tired of trading my time for a paycheck. I want to be able to fire my job and live and go on vacation when I want to go on vacation, hang out with my friends, go places, fly places, without worrying about I need someone to take my time, to pick up these days so I can have these days off in XYZ. And with trading, is super duper flexible. You can pretty much trade in the market from anywhere with internet. You could do it on your phone. You could do it on a computer. You could do it at a Starbucks on their Wi-Fi. You're free to do whatever. You can trade wherever. I remember I went on vacation in New Orleans, and before myself and my friends started to go out to explore the city, I made a couple of trades and made a few $100, and then I enjoyed it. And then I went out with my friends, and we had a good time. I wasn't stressed. I wasn't worried about anything. So it's like little things like that that help you, that trading can help you be able to achieve that you can't achieve with your 9-to-5 job. And then essentially you're your own boss. You get in what you put in. If I study and I do the research on the stocks, and I'm like, hey, I study the patterns on the chart, and I'm like, hey, this looks like a strong buy. I do my due diligence, and then I get into the trade, and then the trade plays out hopefully the way that I play it out, and then I'm done. Like, I don't have to have someone tell me to buy or not buy it. I don't have someone micromanaging me. I'm the person that's making these decisions on my own. I don't need someone else to tell me what to do. So, you also get that type of flexibility. But overall, my why to trading is to be financially free. I want to pay off my student loans. I want to own property. I want to own real estate. I just want to be able to do things that I am currently limited by having a 9-to-5 job. So, those are things that I challenge you guys to think about when it comes to trading, and what you think you want to do, and why do you think you want to do this, because I guarantee you your why is going to be everything. So if you learn anything from this, feel free to share this video with anybody. I know that I speak a lot, I ramble a lot, but ultimately my goal is to help you guys understand why I'm so passionate about this and why this is such a big deal to me. This is information that they typically don't want people to know, or people are super discouraged by, because they think that it's this thing that is unlearnable. But I promise you, if I can learn this, you guys can learn it too. I do have a free Discord community that I post trade ideas in and etc. The link is it will be in the description of this video, and then you feel free to follow my my trading Discord page, FNP Trades, FNP _trades. And then also, if you want more information about like how I pick plays to be successful, the tools, the technical analysis, and some of the things that I utilize to just like make my trading easier, feel free to send me a message, and then we'll work something out with trying to do like a one-on-one. And then as far as like if you feel like you want to take me or anything, it's not an obligation or anything like that. But you can send me something on PayPal, Venmo, Cash App. My handles are down below, so feel free to do so if you want to. But other than that, that is all I have for this video. I would like to thank you guys for tuning in. Thank you guys for watching it, and I hope you guys learned something. And then join that Discord if you guys want to get more of an insight of what I'm thinking when I'm doing trades and stuff like that. Right now we're currently like 50 people strong at the moment, and essentially I tell people, hey, I'm buying this, and people like, all right, let's get into it, and then people have made money from it, so myself included. So I think that is fun. Also my buddy Sean, he's also a co-contributor to the Discord as well, so we definitely have some things going on in there, so feel free to check us out. And again, thank you guys for tuning into the video, and as always, have a great one and be blessed. Thank you.